I don't know why I'm always like, I'll start recording after the prayer. It seems weird to record through the prayer. I don't know. Um, I don't think it's inherently like wrong or anything. It's just, um, anyway, I guess I'm old fashioned. These newfangled recording computers, who knows what they're going to do? Okay. Um, so my plan was I have some lecture slides, I guess, to go through. I find that people often find adjusting entries a little confusing, just the concept of them and the process of them. And so I was going to try to go through some examples of that. Is there, I don't know, is there, so I was gonna kind of hit the adjusting entries and then the closing entries. Those are the kind of the big new learn for chapter 3. Maybe all of you are super strong on those already and are like, we don't need that. I mean, if that's the case, like a generalized lecture may not be as good as specific help. But typically that's the process I use. Does anybody have like some specific problems that maybe after we go through that are killing you?
Number 9, it was just really confusing because there's so many things to look at, and then the different things you're going to fill out. And I've filled out 4 of them, but it's confusing because you're moving from one to the next.
And you're talking
I
about
think if I
9
just concentrate on one and get it all done, then it won't be so hard. But it's just I think of this one and then I move to the next one and then I can't remember.
Right, number 9 on the quiz access you're talking about.
Yeah.
And that's the big,
The huge one with all that stuff going on.
The comprehensive problem, I guess. It sort of takes you through the whole accounting cycle almost all the way through the adjusting and closing. Yeah, it's interesting. In the class where I teach here at Eastern Arizona College, my exam for the first 4 chapters is pretty much a problem. Like, it is an important skill as an accountant to be able to like take one point at a time. But my wife's global. She's an artist and she thinks globally, and I think so narrowly sometimes that I think because of the nature of this work, it's like you don't want to consider global things. You have to consider this specific entry. What's happening? What's the debit? What's the credit? And it's super easy to get like drawn into like the more global picture of it, too often to your detriment. So okay, and I don't know that we'll have time to work through the whole thing. But I've had a couple other people ask about it, and then I look at it and I'm like, I don't know if I want to do a video of that. That could be like an hour-long thing. But maybe I could make, some separate videos of the different parts, and it would still be a lot of time on my side, but it would allow people just to look at the sections where they're struggling and not have to look at an hour-long.
And maybe not just how to do the problem, but kind of just going, okay, this is going to go into here because that's what's throwing me. Because I'm like, because it tells you in the directions, but you have so many things going on that you're like, you forget where you're supposed to be going, and then you lose it.
Yeah.
At least I did have.
Okay. All right. So, okay. I mean, I don't know, does anyone else have like a specific one? That might be all we could even think about getting to is my little presentation here, and then maybe taking a look at that. So why don't we jump into it so that we can do that, since I spent 7 minutes rambling about. Can you do random rambling? I guess so. Most rambling is random in nature, right? So let me share my screen here. Let's see. Share screen, there it is. All right, so the first, let's see, I think that should be shared, right? You guys seeing that screen? Okay. So the first concept in this chapter is the idea of adjusting entries, and adjusting entries sometimes break people's brains, and then other times it just seems natural. It's a funny thing how that goes. But really so the whole purpose behind adjusting entries is to recognize these moments when our cash and our expense, or our cash and our revenue, don't match up with each other perfectly. Okay, because we're doing accrual-based accounting, we need to recognize there may be times when we receive cash, but we haven't yet earned that revenue. So we've got to know how to deal with that. Other times when we we earn revenue, but we haven't yet received the cash, and we're not going to get the cash until some future financial period. Likewise, there's times when we pay for an expense, but we haven't actually incurred the expense, so we prepay, maybe for an expense that's coming up later. Or there's other times when we incur the expense, but we haven't yet paid for it, and so we're going to have to pay for it in some future period. So these 4 types of adjusting entries are really, that's it. They're just these 4 circumstances where the cash and the revenue, or the cash and the expense, don't match up with each other. And I think sometimes we try to think of it as this big confusing thing, and that's really all that's happening. So I'm going to walk through the 4 types and give a few examples, or at least one example of each. So the first is what's called a prepaid or a deferred expense. So this is where, again, so we pay for an expense, but we haven't yet incurred the expense. We're going to incur the expense in the future. And so every time we deal with one of these prepaid expenses, we're going to have to, when we initially make that entry, what we're going to do is we're going to debit an asset, usually called prepaid rent or prepaid. That's the most common thing to prepay is rent or insurance. People will pay for insurance way into the future, right? So we're going to debit that asset account and credit our cash when we initially make that transaction. And then at the end of each time period, month or quarter, whatever, however we record our things, we're going to credit the asset to decrease it, and we're going to debit the expense for that amount of the expense we've actually now incurred during that period. So that's what a prepaid expense is. So let me see if we can look at an example. Or actually, let's look at the process. So Fast Forward pays $2,400 to cover insurance for 24 months. This began on December 1st, 2020. So when they do that, they debit prepaid insurance, which is an asset that represents, I guess, insurance services that are owed to us in the future. Okay. And then our second step is at the end of the financial period, we have to make this an adjustment. So if it's $2,400 for 2 years, we could divide that by 24 months and realize that this represents an insurance expense of $100 a month to be spread out monthly over the next 2 years. So then each month, we're going to do an adjusting entry where we debit insurance expense and we credit prepaid insurance. At the end of 24 months of doing this, our prepaid insurance account will be down to 0, and we'll have claimed the full expense of that insurance at $100 a month. You can see how this makes sense. If we take this whole expense in one big chunk, like when we first pay for it, then it's not going to really match up with our revenues, because this isn't really $2,400 in a single expense. It's actually $100 per month over 2 years. So that's why we do these adjusting entries. So there, our balance at the end of 1 month after we do our first adjustment will be $2,300 in the prepaid insurance account. And we'll have claimed an insurance expense of $100. All right. I think so. That's what the journal entry would look like there. A debit to insurance expense for the adjusting entry of 100 and a credit to prepaid insurance. And so adjusting entries for these prepaid assets always look the same way. The adjusting entry is always a debit to the expense and a credit to the prepaid asset, whether it's prepaid insurance or prepaid rent or whatever. They always follow that same pattern. Supplies kind of work the same way. In that when we purchase supplies, our supplies asset goes up, and supplies are things we're going to use in the future. So when we purchase the asset, we debit that, and we would have been crediting cash. But then the way it's a little bit different is at the end of the period, what you usually do is you count up the supplies and see how much you used during the period. That happens here where I work. If I need sticky notes, I go over to the supply people and I say I need sticky notes and pens, and they write up a little ticket. And at the end of the month, what they do is figure out how much we've used up. And then we do an adjusting entry, a debit to the supply expense and a credit to the asset supplies. And then we have a new balance of supplies that are remaining or available to be used. So that entry, once we figure out how much we've used up, is going to look like this: a debit to the expense and a credit to the asset. So again, these prepaid or deferred expenses always look, the adjusting entry always looks the same: a debit to the expense, a credit to the asset each time. One more version of this that's a little different is called depreciation. We'll learn more about it in depth in the future. But the idea of depreciation is that certain assets, like long-lived assets, or they call them plant assets in accounting, like equipment, buildings, cars, etc., they have a useful life that lasts longer than a single accounting period. And so what we do is we calculate how much of the cost of that asset we're going to claim as an expense over each period of the asset's life. And the way we do that is by taking the cost of the asset, dividing it by subtracting any salvage value, which means any value we think the asset will have at the end of its useful life, and then we divide it by the time in its useful life. So here's an example. They purchase equipment for $26,000. It has an estimated useful life of 5 years, and it's expected to be worth about $8,000 at the end of the 5 years. So what we're going to do is we're going to calculate how much expense we're going to record each year during this asset's life. Again, if we take the full $26,000 as an expense up front, that doesn't really accurately portray the fact that we're getting benefit out of this equipment for 5 years. So instead, we want to spread that expense out over the asset's life. So then we take the original cost minus the salvage value. They call it net cost in this McGraw-Hill book. A lot of times it's called the depreciable value, the amount you're going to depreciate. And then we take that depreciable or net cost and divide it by the number of months and the asset's life. It was 18,000 divided by 60 means we're going to depreciate or claim as an expense $300 of the cost of that asset each month. So we create an entry that debits depreciation expense and credits the accumulated depreciation account. So this is different than the first two examples I gave, because with depreciation, with long-lived or plant assets, we like to leave the asset showing its cost, and then show the cost of the asset being used or depreciated over time in a special account called accumulated depreciation. The accumulated depreciation account is a special account that's linked to the actual asset account. And it's what's called a contra asset. That's an asset that has a normal balance on the credit side, the opposite side that an asset normally would. And when we're figuring out, well, what's the value of the asset, they call it the book value of the asset. It would be the asset's cost, so like this 26,000, less any accumulated depreciation on the asset. So the adjusting entry each period is going to be to debit the expense account, depreciation expense. And instead of crediting the asset account directly, we're going to credit the accumulated depreciation account that is linked to that asset. That's the way it's done with depreciation. On our balance sheet, it will look something like this. They'll show equipment less any accumulated depreciation, and then it gives you this value. And that, again, that value, the cost of the asset minus any depreciation is referred to as the book value of the asset. And be careful we don't confuse book value, cost less accumulated depreciation, with market value. I mean, it's possible that that equipment could have gone up in value because it's really valuable now and people want it or something. And so this just represents our cost minus any amount we've depreciated. It doesn't necessarily represent what the market value of that asset would be at any given time. All right, so that was a deferred expense. I showed you 3 examples of it. The first was a prepaid assets. The second was supplies. And then the third was depreciation. So now we'll move into a deferral of revenue. So with a deferral of revenue, what happens is someone pays us money in advance, but we haven't earned it yet. And we don't record revenue until we've actually earned it. So again, when that first happens, what we do is we would be debiting our cash because our cash is going up, but then we'd be like, what do we do with the cash? Because we haven't earned it. So what we do is we create a liability account, a special liability account called unearned revenue, which represents money received in advance of it being earned. Okay, so the initial entry would be to debit cash and credit the liability unearned revenue. Then as we start to earn that revenue by actually providing services to the customer, we have to do an adjusting entry. And in that adjustment, we're going to debit the liability to decrease it, and we're going to credit revenue to show that we've actually earned it. So that's the process going on there. So here's an example. Fast Forward's client paid a 60-day fee in advance, covering the period from December 27th to February 24th. So Fast Forward earns payment as time passes, and at 12/31, they've earned 5 days worth, which is $3,000. Oh, no, sorry, which was $250. So step 3 was the adjusting entry to reduce the liability. So let's just show the example of what it looks like. So when we get the money, our cash goes up and our liability unearned revenue goes up. Then when we get to the end of the month and say, hey, we've earned a certain amount of that money, we do an adjusting entry to debit unearned revenue, so decrease the liability, and credit the revenue account. Too much animation. All right. So the adjusting entry will look like this: debit unearned consulting revenue and credit consulting revenue. What can be hard about these sometimes is it will just tell you, hey, they got $3,000 and it represents 60 days. And then that's all it will tell you. And then, so you have to figure out, oh, okay, so from the time this contract started to the end of December was 5 days. So I've got to take the full amount, divide it by 60 to get a daily amount, and then multiply that out by 5, right? That's kind of the process they went through. They didn't explain very well to figure out how much that adjusting entry will be. That's sometimes the hardest part of these is like sometimes they're just telling you, oh, this is the amount of the adjustment, and other times they're leaving you to have to calculate it or figure it out. So you have to read them very carefully. So the third type of adjusting entry is called an accrued expense. So accrued expenses happen when we actually incur the expense, but we have not yet paid it. So this happens a lot as we use services. Probably the most common example is our employees working for us. So they'll work each day, they'll punch in on the time clock, or they'll have salaries, and so the wages that they're earning are an expense to us, but we don't typically record those wages until the next payday. But when we get to the end of the month, we would have to recognize we have some wage expense sitting out there that we need to record as an expense, but we won't actually pay it until the next payday. This is especially true, say, companies that pay people on, every other Friday or something like that. They'll have employees that have earned money, and therefore we owe the money to them, and it's an expense that we've incurred, but we haven't yet recorded it. So that's probably the most common example of how that happens. So what we do is we get to that end of the month, we tally up the money we owe and that we've incurred an expense on, and we debit the expense account and we credit the liability account, saying, something payable, usually salaries and wages payable. So here's an example. Fast Forward pays its employees $70 per day or $350 for a 5-day work week. Salaries are paid every 2 weeks on a Friday. On December 31st, or December 31st is a Wednesday. So there's 3 days salaries are owed at the year end. But we're not going to pay them until next Friday's, at the payday. Okay. So we recognize that. We recognize our our employees have worked, we owe these salaries, and we've incurred the expense of them, and we need that expense to show up on our income statement so it's accurate. So, so the process is to take the daily rate, multiply it by the number of days, which is $210, and then create this adjusting entry. We debit salaries expense, and we credit salaries payable. So the adjusting entry for accrued expenses is always the same. It's a debit to the expense and a credit to a liability account. It's a liability because we owe it, but we're not going to pay it till the next payday or whatever other circumstances we'll be paying. So that'll give us a balance in our salaries payable. We'll be able to show our salary expense for the period so that our income statement will be correct. And then we have to recognize that at some future point, we'll actually have to pay the cash, right? That's that we created a payable for. So the accrued salaries of 210 on 12/31, then January 9th of the next year, we'll have to actually pay those salaries. In addition to the salaries everybody's earned from January 1st up to January 9th. So it's going to look like this. When we actually go ahead and pay those salaries, we'll debit salaries payable, that liability account we created at the end of the month when we did the adjusting entry. And then we'll also debit the salaries expense for the money our employees earned from January 1st up until payday. And then we'll credit cash because we're actually paying out the cash. So you have to sort of, in the first two, the deferrals, the cash happened first, and then we had to make adjustments for how much of the expense we'd incurred or revenue we'd earned at the end of the month. In these second two, the accruals, now the expense or revenue occurs first, and then later we have to do this entry to show when the cash actually moves. And so in this case, we're paying cash. When we do the accrued revenue, we'll be receiving cash in the future. So the final type is what's called an accrued revenue. And again, this happens most often in businesses that do sort of like billable work, accountants' offices, attorneys who do work for clients throughout the month. And then at the end of the month, they kind of tally up the amount of work they did and they bill the client. So they recognize we've earned this revenue during the month, and we need it to be recorded on our books so that our income statement will be correct. But we're not going to receive this revenue and probably until the next period, then the next month. So at the end of the month, we do this adjusting entry where we debit the asset, and the asset will usually be called accounts receivable, and we credit the revenue, the money we've earned but have not yet received. That's what the adjusting entry looks like for an accrued revenue transaction. So here's an example. Fast forwards, customer agreed to pay $2,700 on January 10th of the next year for future services over the next 30 days. On December 31st, we recognized that we had earned 20 days worth of that revenue. So that comes out to $1,800. So at the end of the month, we do an adjusting entry to recognize the revenue we've earned and to recognize the accounts receivable, the money that will be owed to us when it's time to pay. So we debit accounts receivable, that's increasing an asset, and we credit the revenue account, which is increasing the revenue. And so that's going to allow us at the end of the year to have accurate revenue for our income statement, and then also have that accounts receivable showing that money is still owed to us. In the future, when the customer pays us, we're going to show the total cash of $2,700 that we got from the customer. $1,800 of it is in the form of accounts receivable. That's the money we earned in the previous financial period that we're now getting paid. And then the other $900 is for any revenue we've earned during this period, this year. Okay. All right. That was a lot, but there's still a couple more things. Sorry. So the first is, how do we prepare financial statements from an adjusted trial balance? So after we do all of those adjustments, We take our unadjusted trial balance, which we would have had, and then we calculate the new balance of all the accounts with those adjustments in it, and that creates what's called an adjusted trial balance. That's right here on the upper right. What's nice about a trial balance is if this were old school and you were having to create financial statements, the trial balance gives you all the info you need to do that. It has the assets, the liabilities, the stockholders' equity, the revenue and expense accounts, and the dividend account all summarized in a single document. So the first thing we're going to do is prepare the income statement. That's our revenues minus our expenses, and that's going to give us our net income. Once we have our net income, we can prepare our statement of retained earnings, which is our retained earnings at the beginning of the financial period, plus any net income, minus any dividends, which gives us the retained earnings at the end of the financial period. And so we can see this business was brand new, so there was 0 retained earnings at the beginning. We add the net income, which we calculated up here on the income statement. We subtract the dividends, which we can see up here on the trial balance. And that leaves us with the retained earnings at the end of the financial period. Remember, retained earnings is just any net income or profit a business makes that it doesn't pay out to the owners as dividends. And we tend to retain those earnings so that we can invest them in future periods of time. Once we have our statement of retained earnings, we can create our balance sheet, which summarizes our assets, again, pulled right off of the trial balance, our liabilities, which are our debts, again, pulled right off of the trial balance, and our equity, our common stock, which represents money put in by the owners, and then our retained earnings, which we calculated over here on the statement of retained earnings. Of course, with the balance sheet, those things all have to add up. Assets have to equal liabilities plus equity. So it's actually really nice that a trial balance gives you all the info you need to just do that work. And I kind of like how this diagram like lays it out. It's a nice little diagram. All right. So the last thing is closing entries. So we have to recognize that there are some accounts that we consider permanent and some accounts we consider temporary. And by temporary, what we mean is these are accounts that we are going to need to reset to 0 each month or each accounting period. The reason is because we measure revenue and expenses and dividends across the period. How much revenue did we make from January 1st to January 31st? How much expenses did we incur from January 1st to January 31st? Whereas things like assets, we don't measure across a period of time. We would say, well, how much is, how many assets, how much assets do we have as of this day, January 31st? How much liabilities do we have as of this day? So these accounts that have to be reset to 0 because they measure the change or growth in something over time are called temporary accounts. And they are the revenue accounts, the expense accounts, the dividend accounts, and then this special account called income summary that we create really only for the process of doing these closing entries. And our goal when we close is to summarize all of these accounts into a single amount and then post them to a permanent account. That account is retained earnings. So here's the process. First, we close the income statement credit balance accounts, which really means we close the revenue accounts. Second, we close the expense accounts to income summary. Third, we close the income summary account to retained earnings. And then finally, we close our dividends directly to retained earnings. So that's the process. 4 steps, 4 joyful steps to closed accounts, right? So here's what it looks like. Each of our revenue accounts at the end of the financial period will have a credit balance. Why? Because that's the normal balance for revenue accounts. It's either going to have a 0 balance or a credit balance. Okay. Each of our expense accounts will have debit balances. Why? Because that's the normal balance for an expense account. So we start by closing the revenue accounts. And all we do is we say, okay, this has a credit balance of $7,850. And so to close it, all we'll do is debit that account $7,850. That will leave the account with a balance of 0. But I can't just debit. I can't just do a debit without a credit somewhere. So my closing entry will be to debit consulting revenue, 7,850, and credit income summary, that same amount. Likewise, rental revenue, which had a credit balance of 300, I will debit 300, and I'll credit income summary. So now I've credited income summary $8,150 and debited these revenue accounts so they have balances of 0. I've successfully closed them out. They're reset to 0, ready for a new month. My expense accounts all have debit balances. So I will credit each of those accounts an amount equal to their balance, which will bring their balance to 0. And then I will debit the income summary account. Now I've successfully closed my expense accounts, and income summary has a balance in it. If it has a credit balance, it means I had more revenue than I had expenses. If it has a debit balance, it means I had more expenses than I had revenue. So in this case, we have a credit balance. If you think about it, that represents net income because it's our revenue and our expenses. So then I'm going to close out that balance and income summary. So if it had, in this case, it has a credit of 3785, I'll do a closing entry, debit of 3785 to income summary, and a credit to retained earnings. Remember, retained earnings is an equity account, so crediting it is increasing it. So in this case, where I had more revenue than I had expenses, I ended up with a credit balance and income summary, and then closed it by debiting income summary and crediting retained earnings, thereby increasing retained earnings. If you think about it, it's me taking my profits, my net income, and passing them into the permanent account retained earnings. The last thing I do is I look at my dividends account. It will always have a debit balance. So I'll credit dividends, and then I will debit retained earnings, which effectively reduces retained earnings, because dividends is really just paying out of money to the owners. And so in the end, retained earnings goes up by our net income, down by our dividends, and there's our new balance in retained earnings. That's the closing account. Once I do all that, revenue, expense, income summary, and dividends are all back to 0, ready for a new month of keeping track of our business transactions. And that's it. I told you it was quite a bit of info to cover. I hope it was helpful. Any questions that arise out of those concepts, I guess? I went pretty fast too, I know.
And then you do the post, right? The post closing.
Yeah. So then, once you've done that, you can create a post-closing trial balance, which in essence will just have only the asset, liability, and equity accounts in it, because the revenue and expense accounts will all be 0. Let's see. I think I don't have that up already. Yeah. Everybody loves two-factor authentication, except for when you forget your phone. All right, so we're going to look at Chapter 3 and quiz access, Chapter 3. Aren't we glad it's due on Saturday now? That was a mistake that freaked everybody out. You're welcome, I guess. I mean, I didn't do it, but I guess I should have caught it. We're going to preview this assignment. We're looking at question 9, right? So what I did is I pulled this up in like teacher mode, which means it already has answers put in, because I think it might be more valuable for us just to kind of walk through it than to try to have me work it all out. Excuse me. I didn't want to sneeze right in your ear, so I covered that, but then I grabbed the microphone, so it may have been just as bad. Anyway, so here we have this travel agency and a bunch of transactions for them. And this is like a brand new company, right? So they're starting with an investment by the owners. And then they give you a chart of accounts, and then they give you all this information you're going to need to do adjusting entries, and then they tell you all of this is required, and then they kind of step back and just watch you and see if see if they can watch you flounder. Like, thanks, McGraw-Hill, that was very kind of you, right? So so the process, of course, is to just start to go through this thing piece by piece. And so first is to do all these journal entries. Did everybody feel like they understood that pretty much, like the journal entries, or is that something that we should talk through a little? Because that's kind of review stuff we did in previous chapters, right? All right. So then, so that's the first requirement: prepare the journal entries. And again, I mean, it's just walking through those journal entries. And then the second, let's see, the company records prepaid. Okay, so so requirement 3 is they want us to use the account balances to prepare an adjusted trial or unadjusted trial balance. So again, once we have all of this info, because it was a brand new company, they didn't have balances in any of the accounts. So we can just go through and we can tally them up, right? We can say cash was debited 30,000, credited 1,800, credited 1,000, and we can figure out the balance of the cash account. And we can do that for each account. So then we end up with this unadjusted trial balance that has a balance to cash and each account thereafter. What I don't like about the setup of this one is, like, accounts receivable here has no balance in it. And in real life, trial balances, just if an account doesn't have a balance, they usually just don't exist. They just don't show up on the trial balance. So that could be a little confusing. Like, I think like half the time the problem with these are like, I kind of know the concept and how to do it, but I don't know what they want from me. Do they want me to include that line or not include that line? And I mean, that's frustrating. But at the same time, it's better than, when I started teaching, where you would have to do this by hand on a piece of paper and wait a week for me to get feedback back to you. At least there's more immediate feedback, which helps. But I'm feeling your pain, I guess is what I'm saying. So after we do, again, stop me and ask questions if somewhere along the way you're like, yeah, you're glossing through this, but this is where I need help. The 4 is to journalize the adjusting entries for the month. So here we have to look at each of these. So we say, okay, prepaid insurance of $133 has expired this month. So I just learned in Mr. Fox's incredibly gifted lecture that prepaid insurance and adjusting entries are always going to be a debit to expense and a credit to the asset. So this one says $133 expired. So I'm going to debit insurance expense, credit prepaid insurance at the end of the month. But this one's a little tricky. This one says at the end of the month, $600 in office supplies are still available. So that leaves me to have to look back at the trial balance and say, okay, there was $1,000 worth of office supplies. If 600 are still available, then I must have used up 400 during the month. So then my journal entry is to debit the supplies expense, credit the asset office supplies by $400, thereby leaving the new balance of that account at 600. Those can be more confusing. On this first one, they gave us the amount. Here we had to calculate it. C, the month's depreciation on the company's equipment is 500. Well, that's nice of them. They're just telling us how much. So again, we debit depreciation expense, credit accumulated depreciation. D, the employees earned 420 of unpaid, unrecorded salaries. So again, we're accruing this expense, recognizing we've earned it, or incurred it. So we debit it 420, and then that we haven't paid it yet. So we're going to credit the salaries payable in the next month. We'll pay it. Finally, the company earns $1,750 of commissions that they've not yet billed. So we're going to record that as an accrued revenue, which means we're going to debit the asset accounts receivable and credit the revenue account. So there's our adjusting entries. Once we've done this, so here we already had our unadjusted trial balance. We've made changes to these accounts, and so we're going to have to account for those in the adjusted trial balance. And that's just going to have the balances of each of these accounts with the adjustments figured in. Then 5A, we're going to take this info and we're going to create an income statement. So we can look on here and say an income statement has revenues and expenses. So here's my revenue account. Here's my expense accounts. And those amounts carry forward here to the income statement. Then we're going to do our statement of retained earnings, which is going to have our beginning retained earnings, which was 0 because it's a new company, plus any net income, which we calculated right here, minus any dividends, which we're going to have to go back to the trial balance for. And that will give, and then that will let us calculate the retained earnings at the end of the period. Then we're going to do our balance sheet, which is going to be our assets, which again are right on the trial balance, our liabilities on the trial balance, and our equity. Common stock was on the trial balance, but the retained earnings we calculated back here in our statement of retained earnings. Next, we prepare the journal entries to close the temporary accounts. So first, we close our revenue by debiting revenue, crediting income summary. Then we close our expenses by crediting the expenses and debiting income summary. Then we're going to have some balance since we credited 9750 and debited 7553. We know that income summary will have a credit balance of 2,197. So we close that by debiting income summary, crediting retained earnings, and then we close our retained earnings by debiting retained earnings and crediting, and crediting dividends. I say close retained earnings, we're closing dividends by debiting retained earnings and crediting dividends. So again, this is a fast run through. Don't be afraid to ask a question. And then this general ledger part, I noticed several people asking questions, like this one freaked everybody out. But really all this is like a running T account, okay? So we go back to these entries we made all the way back in the first one. And we say, okay, I debited cash 30,000 on April 1st. I debited computer equipment 20,000. I credited common stock 50,000. So I come back over here. I record the debit on April 1st of 30,000 there. The debit on April 1st to computer equipment here of 20,000, and the credit to common stock somewhere. Where is it? There it is, of 50,000 on that same day. Honestly, the easiest way to do this is to come back to these entries, take a picture of it with your phone camera or something like that, and then you'll have all of these entries over here. And then all you're doing is you're just recording each entry by day and giving the balance at that time. Finally, you do a post-closing trial balance, which is just going to have the balances of each of these accounts. So cash will be 27,000 on the debit side. Again, I'd probably take a picture of these and then come over here and do cash 27,000, account receivable, and so forth. And hopefully it all balances. Okay, so I ran through that pretty quick. Marona, was it helpful? Did it sort of line it out?
It was. I think I saw where I made a couple mistakes, and I'll just go back and redo those areas.
Okay. Well, I'm afraid I'm out of time. I'm actually a little over time, and our haunted walk that we're doing for the youth will be less scary if I'm not there.
Thank you so much.
So I appreciate everybody taking the time to be here. I'll post a recording of this if you want to go back and review some of those, maybe as you're working on that problem. And I'll go ahead and offer a closing prayer. Our dear Father in heaven, we are grateful for BYU Idaho and the potential it allows for so many people to get an education, to increase their earning potential, and just to increase their knowledge. We are grateful especially for our Savior and his atoning sacrifice on our behalf. We ask that thy Spirit would be with us, that we might know thee better, that we might be one with our brothers and sisters, that we can stop fighting against thee and find the peace that comes through faith in thee and thy Son. We love thee again. We ask a special blessing on all those who are working through this class, that thou would strengthen them and help them to learn the things they need to, that they might be better and stronger servants in thy kingdom and in their families. We love thee, Father, and we say this in the name of Jesus Christ. Amen.
Amen.
Thanks, everybody.
Thank you.
Have a great night.